Good evening, Rankesh. Let's wait for around 2 to 3 more minutes to check whether others are joining. Then we'll start on the session. All right, guys, let's start. So today let's have a chat on the what do you call specimen paper, shall we? Right. So by any chance, did you try the specimen paper, the June 2024 one? Okay, great. How was it? Good or bad or how was it? Yes, I also agree with that point. This specimen that they have given is not that tough. I totally agree with that. This is more or less like a very straightforward one. And certain questions were, yes, hub questions are threatening. The pre-mock that they have given is a bit of a simplex one. But the thing is, we cannot purely deny the pre-mock as well because this is the first paper they are coming after the adopting the new Finance Act 2023. So usually, up to now, the practice has been whenever they adopt the new Finance Act, generally the first paper is slightly easier than the other papers. There was a trend like that. But let's not take that granted. Let's be vigilant about the paper as well. But since they have given the pre-mock, let's walk through that as well. Are we okay? Great. So let's quickly go through the section A parts. None of these were complex, as you said. Mia works full-time in Spain and was not UK resident in the tax year 2023-2024. During the tax year 2023-2024, she spent 60 days in UK. Which of the following statements regarding Mia's residence status for the tax year 2023-2024 is true? So when they give a data like this, we have to recall on what we have studied about the residency rules. So when we are doing the residency, we had three steps. First, check on the automatic UK non-residency test. Then check on the automatic UK residency test. After that, if none of them are satisfying, we have to go through the sufficient ties. So this question, clearly we can disregard the sufficient ties because we don't have information about the sufficient ties at all. So this will be revolving around automatic residency and non-residency tests. First comment is Mia is automatically UK resident. That we can't say like that, right? Because none of the UK residency tests are satisfied. Anyway, we have to first check the non-residency ones before we move on to the residency. Mia will only be UK resident. Okay. Next two are talking about the ties. Like I said, we don't have information about the ties. So we can simply disregard the ties at the moment. Last one, automatically not UK resident. Yes, I agree. Because she is working full-time overseas. Spain is not within UK. Spain means overseas. So working overseas, that means up to 90 days you can stay in UK if you are working full-time overseas. So she has spent only 60 days. So yes, we can say she is a non-resident. So I'm taking the correct answer as the fourth one. And moving on to the next question. Louis's, okay, Louis has an annual salary of £57,000. She received child benefit of 2,902. What amount of child benefit tax charge must Louis pay on the tax year 2023-2024? Right. When this kind of a question is given, uh, well, I mean, in the past, what I have observed is students doesn't feel that this is straightforward. So they try to make it complicated. So according to my observation, when this kind of a question is given, people tend to deduct the personal allowance from this 57,000 and say there is no child benefit charge because the taxable income is less than 50,000 pounds, which is not the case. Don't do that kind of a mistake. Don't try to complicate the question on your own. It's a very straightforward one. Child benefit charge goes based on the adjusted net income, not the taxable income. So in this case, adjusted net income would be 57,000 pounds itself. So there would be a child benefit charge. So let's see how are we going to calculate that. So I took the salary 57,000 pounds. The limit is 50,000. I have an excess over the limit of 7,000 pounds. 7,000 divided by 100 means 70 100-pound slots. So that means each 100-pound slots we are charging 1%. So we will have to charge 70% here. 70% of the 50,000 means, sorry, what they have received is 2,902. 70% of that means 2,031 pounds. So do we have that answer? Yes. Second one is that particular answer. So I'll be just walking through Lankesh. If there are any queries, just stop me and raise the query. Yeah, yeah, okay. Right. Then we have Zepter Limited holds 80% of the ordinary share capital of Quiver Limited and 60% of the ordinary share capital of Gale Limited. Quiver Limited holds 85% of the ordinary share capital of Breeze Limited. Select whether Breeze Limited and Gale Limited would be a part of a group relief group and or chargeable group with Zepter Limited by clicking on the relevant boxes below each company. First, let's see group relief group. Breeze. So Breeze is coming through Quiver. So Zepter hold 80% of Quiver and Quiver holds 85% of Breeze. How much is the effective percentage? 80 into 85. How much is that? 80% into 85%. That is 68%, which is below the 75% effective ownership percentage that we have been discussing. So it will not come under the group relief group. But does it comes under chargeable gain group? Yes, that we can consider. Then Gale Limited. Gale is only having 60%, so it will not fall under either. Chargeable group is also out of the equation. Group relief group is also out of the equation because the direct ownership itself is only 80%. Sorry, only 60%. So 60% is not sufficient to create either of a group. So Gale doesn't create any kind of a group. So if I tick the correct answers, Breeze will create a chargeable gain group only. Gale will not create a group at all with Zepter. Moving on to the next one. For the tax year 2023-2024, Ethan make a trading loss of 97,000 pounds and had employment income of 12,000 pounds. For the year 22-23, he made a trading profit of 20,000 pounds and had employment income of 75,000 pounds. Coming through a subsidiary, the simple percentage will be fine. But direct ownership, then it should be 75%. Are we good? For group relief group, either way, you should have the 75% story. Yes. For sub-subsidiary, you can say more than 50%. Yes, for chargeable gain group. Right. Okay, so his trading profit for the previous tax year is 20,000. Employment income is 75,000. How much of the 97,000 trading loss would be set against Ethan's total income for the tax year 2022-2023? Okay, so if we take this question, this was one of the small tricky question. I mean, this is not a very heavy one, but had few tricks of his own. You can't just carry back because we have the limit of 50,000. So if you are setting off against the total income, only 50,000 can be set off. But you have a trading income as well, which is 20,000. So against trading income, there is no limit. That 20,000 is anyway available for you. On top of that, another 50,000 is available against the employment income. So 20 plus 50 would be 70,000 pounds. Again, I'm just repeating. When you are taking backward, the limit is only applicable for other sources of income. Profits from the same trade, there is no limit. So last year's trading profit, 20,000 can be fully set off. Then against the employment income, you have another limit of 50,000. Up to 50,000 you can claim. So 20 plus 50 would be 70,000. So if Ethan wants to go back up to 70,000, he can set off against the overall income. Elankesh, are we okay? Great. Then the next one, which two of the following are taxable income? Premium bonds, is it taxable? No, we discussed that is exempted. Interest received from NSNI investment account. So this is a bit of a tricky one. Interest received from NSNI certificates are exempted. That is what we discussed. NSNI certificates. Here they are talking about an investment account, which is not covered under the exemption. Exemption only covers the interest received from NSNI certificates. So this is a taxable one. It's not coming under the exemption. Third one, dividends received from ISA exempted. Interest received from giltage securities, it is taxable. Interest received from an ISA exempted. So the two taxable sources of income here would be interest received from an NSNI investment account and interest received from gilted securities. Rashid, are we okay? Great. Then next one. Lucy made a gross pension contribution of 85,000 for the tax year 2023-2024. Her adjusted income for the tax year was 290,000 pounds and she had no unused annual allowances brought forward. What is the annual allowance charge that will be added to Lucy's taxable income for the tax year 2023-2024. Okay, let's move on to a working and see how are we going to deal with this one. The basic KA or the annual allowance for the current year is at £40,000. Income is at 290,000 and we have a limit which is 240,000. So we have an excess of £50,000. 50% of that would be the reduction in annual allowance. So 50% of 50,000 would be 25,000. So once we deduct 25,000 from the AA 40,000, the adjusted AA would be 15,000. Actual contribution she had made is 85,000. AA is sufficient to cover 15,000. 85,000 minus 15,000 would be 70,000. So this 75,000 would be exposed to the additional charge. So do we have that answer? Yes, 70,000 would be answer number 3. Then the next question. Diego submitted his self-assessment tax return for the tax year 2022-2023 on 5th October 2024. The total tax due was 5,300. What is the maximum late filing penalty that Diego will be charged? So let's move on to a working and see how are we going to deal with this whole penalty calculation story. Anyway, if there is a delay, we have the initial penalty of £100, right? So we start from that. Then the delay is more than 3 months, obviously. So we have £10 per day penalty, daily penalty, up to 3 months. So 90 into 10, £900 will also be there. Then we have the geared penalty, the percentage penalty, 5%. 5,300 is the unpaid tax amount. That into 5% would be 265. But we have a minimum requirement. If we have to go for the geared penalty, the minimum requirement would be £300. So 265 will be replaced by 300. So 3 penalties are there. Initial penalty 100. Daily penalty for 90 days 900. The geared minimum penalty 300. 900 plus 100 plus 300 would be 1,300. So do we have that answer here? Yes. Answer number 3. Both of you are okay with the penalty calculation? Elankesh, how about you? Right. Then the next one. Harriet is self-employed. Her total tax liability for the tax year 2022-2023 was as follows. Income tax, Class 2 NIC, Class 4 NIC, and CGT. What will be the amount of each of Harriet's payment on account for the tax year 2023-2024? So when we are deciding the payment on account amount, what should we do? We have to get the data of the previous year. We take the income tax, we add the Class 4 NIC and divide by 2. So income tax is 13,500. Class 4 NIC is 3,370. The total amount, the gross one, is 16,870. Divided by 2 or 50% would be 8,435. So we just need to type that answer here. We are okay with this one as well? Yes, if there was a PAYE, we have to deduct. Correct. I agree with that. But in this case, no PAYE because she is only self-employed. Therefore, that complication is not there. But question is correct. If PAYE was there, when we are dividing, before that, we have to take out the PAYE. We have to deduct that. Right. The next question. Click on the relevant boxes below to identify whether each of the taxes listed is a direct or indirect tax and whether a capital or a revenue tax. So inheritance tax is a direct one and it is a capital tax as well. So for that, I ticked direct and capital. NIC, direct, but it's not a capital one, it's a revenue tax. For that, I ticked direct and revenue. Moving on to the next question. Weigh held the following income and gains for the tax year 2023-2024. Taxable trading profit, £47,000. Chargeable gain on the disposal of a painting, 8,500. What is Weigh's capital gain tax liability for the tax year 2023-2024? Again, guys, this is again a bit of a tricky question which I have seen. Some of the students in this kind of a question, they see the first sentence, taxable trading profit. They consider that as the taxable income. And then it's above the basic rate band, right? 37,700. So they feel nothing will fall within the basic rate band. So we can apply the higher rate of CGT straight away. Again, that is not the actual situation. Because the given 47 number is not the taxable income. That is the taxable trading profit. So we have to deduct the personal allowance from this £47,000. Then only we can derive on the taxable income. This is not the taxable income. We are good? Right. So I'm moving on to the Excel. Trading income is £47,000. I deducted the personal allowance from that. Then the taxable trading income would be, taxable income would be only 34,430. My basic rate band is 37,700. That means we do have an excess of 3,270. Chargeable gain is 8,500. From that, we have to deduct the annual exempt allowance because chargeable gain means prior to deducting AEA. So I deducted the 6,000 AEA as well. Then the taxable gain is only 2,500, whereas my lower rate is applicable up to 3,270. That means this entire 2,500, I will have to tax at the lower rate of 10%. So 2,500 into 10% would be 250. So the correct answer would be answer number 3. Are we good with this one, guys? Any questions? Rashid, how about you? Great. Then the next one. Kwame acquired a piece of contemporary artwork for £18,000 in July 2011. July 2011, incurring authentication fees of £600. Kwame sold this artwork for £4,000 on 1st April 2024, incurring gallery fees of £400. What is Kwame's allowable capital loss? Again, guys, this is also a bit of a challenging one. The thing is, the £6,000 rule comes into the picture here. Yep. So the questions are not hard, but kind of tricky in this, what you called free mock that they have given. Not tough, but bit tricky. So here also, yes, I agree. They have brought at 18,000 pounds, but they are selling only at 4,000 pounds. That means what? The 6,000 pound rule comes into the picture. That is point number one. Second thing that they have tried to confuse here is the authentication fee. They are saying the artwork purchased at 18,000, including the authentication fee. Again, most of the students in this kind of a question will again add this 600 pounds to the cost, which is wrong. Because based on the way that they have worded the question, this 18,000 pounds include this 600. Yes, gallery fee we have to deduct. Authentication fee is already included in this 18,000. So two things that we have to note down. One is the 6,000 pounds rule. Second one, this whole authentication fee story, which we need to take out, like Elankesh said. So 6,000 pounds will be the proceeds now, because according to the 6,000 pounds rule, if you brought the purchase cost is above 6,000, but the sales proceed is less than 6,000 pounds, we have to get the deemed sales proceeds as 6,000 pounds. So that's what I did. I took the 6,000 here. Then the cost is 18,000 pounds. Selling cost or the gallery fees is 400 pounds. Authentication cost is 600 pounds. I took everything out. Then the allowable loss in this case would be 13,000 pounds. Do we have that here? Yes. Answer number 2 is 13,000. We are good. Any questions here? Rashid, how about you? Great. Then question number 12. Jin made the following cash gifts during his lifetime. Okay. Cash gifts during the lifetime, we know where are they going to touch? Inheritance. So 30th July 2015, he has made a gift to his son, 260,000. 10th August 2016, he has made a gift to his daughter, 600,000. So both are seems to be PETs. Both amounts are stated after applying any available exemptions. That means annual exemptions, AEs, are already deducted when they derive this 260 and 600,000 pounds. Jin died on 8th January 2023. How much inheritance tax is payable as a result of Jin's death in respect of the cash gift of 600,000 pounds to his daughter? Okay. First of all, is it falling within the 7-year barricade? The gift is in 2016 August. Yes, seems like yes. How about the previous gift? July 20th July 2015. That is not falling within the 6-year barricade, right? So that means nil rate ban seems to be fully available for the second gift, isn't it? So what am I going to do? 600,000 pounds is the transfer of value. Nil rate, 325,000 pounds. The balance is 275,000. 40% on that would be 110,000. We have the taper relief. So if I calculate the time gap, it would be around 6 to 7 years, isn't it? It will be falling within the 6 to 7 years time bracket. Am I correct? Do you guys agree? Great. So then what is the taper relief for that? Just go to the tax rate tables. Take the tax tables one. 6 to 7 years, the taper relief would be 80%. So we have to take 80% here. Correct. So I applied 80%. So the taper relief would be 88,000. IHT will be only 22,000 pounds. So the correct answer would be first one. We are good with that? Any questions? Great. Rashid, Rashid, are we okay? Great. Okay, next one. Omega Limited has a corporation tax liability of 1,050,000 pounds for its 7-month accounting period ended 31st July 2023. Omega Limited is a large company and has paid its corporation tax by installments for several years. Click on the relevant boxes below to indicate the due date and the amount of the first installment for Omega Limited's 7-month period ended 31st July 2023. This is also tricky. Okay, what was the trick here, Lankesh? The amount. All right. How did you derive on the amount? Number of installments. Okay. You took as 4 installments. Okay. So you divided 1,050,000 by 4. Right. So how much would that be if I divide 1,050,000 by 4? It's the first one, right? 262,500. Yes, that answer is also there, sadly. The thing is, guys, in ACCA, if we make a mistake, that answer would also be there in your exam. That is the problem. Are we okay? Unfortunately, your examiner is also thinking in the same way that we might think. He also thinks what kind of errors we might commit when we are doing the calculation. So based on that errors, also the answers would be there in the choices that he gives. Right. So what is the correct way to do this one then? If we move on to the, okay, so we agreed that 262,500 is not the correct answer. Then how would we derive at the correct answer? What would be the mechanism that we need to use? Elankesh, Rashid, what are your thoughts? Guys, okay, for 12 months, every 3 months, all right. For 7 months, have to apportion, okay. So how do you apportion? Yes, 3 divided by 7, correct. After that, yes, that into 1,050,000 pounds. So simply, I totally agree with what Elankesh explained. 4 quarters for 12 months means for each 3 months we are making a payment. Then we have to apportion that and figure out how much is for 7 months. So we have to take that proportion. After that, we have to apply that on the 1,050,000 amount, which leads us to 450,000 pounds. Rashid, do you also agree with that? Yes, final payment would be the balancing amount, correct. All right, great. Elankesh, are you okay with the amount? Your explanation was super. Right. So what would be the date that we need to pay? Yes, 14th July. But just because I have clicked this, don't think that is the correct answer. So because I also did this entire pre-mock thing. When I was doing, I clicked the answers. So that's why some answers are highlighted here. So don't just go by that. Huh? I didn't just tick the correct answers. Whatever I felt correct, I just tick that. It's less than 12 months. It's 7 months. Okay. 7, 10, 13, 16. All right. So 14th of the 7th month would be 14th July, right? Right. So this would be the correct answer then. 450,000 pounds would be the installment amount. 14th July 2023 would be the date that they have to make the payment. Right. Moving on to the next one. Calvin started his business on 1st June 2022. His sales, exclusive of VAT, were £9,000 per month for the first 3 months. For the next 3 months, his monthly sales increased to £10,000 and then £11,000 per month after that. From what date will Calvin has to charge output VAT on his sales? To decide that, first of all, we have to figure out on which month he is exceeding the threshold of £85,000. So I did a small working on that. First 3 months, 9,000, then 10,000 each, then 11,000 each. By end of March, he's surpassing the, sorry, end of Feb, he's surpassing the £85,000 limit. Then from when should he start charging? He has to notify before the end of March and he has to start charging from 1st of April. So by the end of, before the end of March, he has to communicate and get the registration. From 1st of April, he has to start charging VAT. Great. Then I'm moving on to the last question in section A. Maria rented out a furnished room in her main residence for £900 per month throughout the whole tax year. Her expenses attributable to this room was 1,500. Assuming that Maria makes the most beneficial election, what is her taxable property income for the tax year 2023-2024? Again, this one I would say a bonus question. This is a straightforward one. Rent, just multiply what they have given is per month, multiply by the number of months, then deduct the renter room relief. It's very straightforward. Yes, property income and employment income, time to time, some basic stuff they test in section A and section C. But yeah, property income, very rarely they test. So this is one of those rare instances. So simply what we have to do here is income would be 900 pounds into 12, which is 10,800, minus the rental room relief 7,500. So the assessable property income would be 3,300. That is answer number 3. So this is why they don't test this property income that much, because in these tiny questions, they cannot give the tough parts of property income. If they want to give a tough question, then they have to ask you to evaluate the FHA, whether it's FHA or not. Then maybe within one property, you can ask to do the accrual basis calculation and another property at the cash basis calculation. These kind of stuff can make a tough question, but it's tough to put that in the exam. Can do, definitely can do. But if they're doing that, that should be a section C question. Because otherwise they can't allocate the marks, no. In these multiple choice questions, it will be tough. Yes, certain capital expenses are included, correct. Are we good? Can we move on to section B? Right. Rashid, are we okay? Awesome. Then I'm moving on to section B. All right. As you guys already know, section B will be based on a scenario. So today I am going to do the section B is also based on scenarios. So I'm going to do with a bit of a shortcut sort of a thing rather than going through the entire case at once. I'll go by requirement. First, I'll read the first requirement. First requirement is what is the amount of inheritance that would be received by Sanjay from Rajiv's estate? That's the first question. Now let's read through the information that we have in the scenario. Rajiv and Jamal were in a civil partnership. Rajiv died on 10th Jan 2024. Rajiv's estate. Rajiv left an estate valued 1.2 million for inheritance tax purposes after deducting allowable expenses 50,000 pounds. Again, a bit of a tricky thing. This 50,000 is already deducted. So we can't consider that again. That is already included. Under the terms of his will, Rajiv left 500,000 pounds to his civil partner. So that will be an exempted legacy. And residue of the estate to his brother Sanjay. Rajiv has had a sorry, he hasn't made any lifetime transfers. So that means the nil rate band is available. So it's not a tough question. Only this 50,000 is a little bit confusing. So if I move on to the answer, 1.2 million is the estate value. Allowable expenses, I am not deducting because they say it is already deducted. So I'm not considering that again. Then we have exempt legacy of 500,000 pounds. I took that. Nil rate ban of 325,000 is already there. I took that as well. Then the taxable estate would be 375,000 pounds. IHT on top of that would be 40%, which is 150,000. Once I adjust all these, the remainder would be 550,000 pounds for what you called Sanjay. Estate is 1.2 million. Exempt legacies I took out. IHT I took out. So once I take out 500,000 plus 150, 650,000, the remainder would be only 550,000 pounds. Do we have that answer? Yes. First one is 550,000. Are we good? Rashid, Elankesh, are we okay? Right. So guys, a small tip, this calculation of residue of the estate is a common question that they used to ask most of the time. Whenever they are putting this whole inheritance tax story into a question, this has been one of the repeated questions, I would say, in the exam. So be prepared for that. Since it is repeated several times, might be there in for you all as well. Then let's see question number 2. Which two of the following would not have been included in the 50,000 pounds of allowable expenses that were deducted from Rajiv's estate? For this one, we don't need to read the scenario itself. We just to figure out what are the non-deductible expenses. Funeral expense, we allow to deduct. Cost of a tombstone, we allow to deduct. Executor's fees, nothing to do with the inheritance, right? So we cannot allow to deduct that. Gambling debt that he has to pay to a friend, again, no legal obligation, so we cannot allow. Payment of Rajiv's credit card, legal obligation, we have to allow. Income tax, obviously, we have to allow. So what are the two expenses that we cannot allow to deduct? Executor's fees and repayment of gambling debt owned by Rajiv to his friend. We are good with this one? Great. Then I'm moving pension fund. This is relating to this question or a different one, Elankesh? Okay. Pension fund is not relating to Rajiv, right? On the Rajiv's estate, they are not mentioning anything about the pension fund. Am I correct? In a comment question, pension fund. If there is anything receivable from a pension fund, yes. If any amount receivable from a pension fund, then that should be a part of the estate. Are we good? Received, we cannot figure out when it comes to a pension fund because by the time we are paying the inheritance, we might not have received it. So whatever the confirmed amount from the fund, we can consider as a part of the estate. Are we good? Right. Then moving on to the next one. How much of Jamal's 15,000 pounds gift to Lee would be covered by the inheritance tax lifetime exemptions? Okay, let's see. Jamal, he has made 3 lifetime gifts. We are speaking about the first one, gift to Lee. Jamal gave 15,000 pounds to his nephew, Lee, on his wedding day, 16th June 2023. This was Jamal's first lifetime gift. Okay. So if it is the first lifetime gift, the annual exemption of the current year as well as the previous year is available, right? So 3,000 plus 3,000, 6,000 pounds is anyway available. Apart from that, this is a wedding gift. So we had a marriage exemption as well, which says any party to the wedding up to 1,000 pounds is exempted. So now 6,000 plus another 1,000, which is 7,000. So simply we can figure out the answer 7,000. Are we good? if gift is a habitual practice. What do you mean by a habitual practice, Elankesh? Oh, habitual practice one. It's a bit of an arguable one. Usually, what happens is it's not coming through the habitual thing. But what happens is these habitual stuff will be covered under the normal expenses out of income, isn't it? These, for an example, your birthday gifts and those stuff will not affect your estate value, isn't it? So that will be covered through the normal expenses out of income exemption itself. It's not a additional thing that will be covered under the normal expenses out of income one itself. We don't have a amount limit for that one, no. As far as it doesn't affect your estate value and it doesn't affect your lifestyle, we are okay to allow that. So the habitual stuff will come under that one because these are small stuff which will not affect your lifestyle. Am I correct, Elankesh? Right. Okay, then I'm moving on to the next question on this one. For inheritance tax purposes, what was the transfer of value of Jamal's gift of 5,000 shares of Zenith Limited to Neelam? Okay, let's see. On 15th September 2023, Jamal gifted 5,000 shares in Zenith Limited to his niece, Neelam. Before the gift, Jamal owned 20,000 shares in Zenith Limited, which has a total share capital of 50,000 shares. The value of the shares of Zenith Limited on 15th September 2023 were as follows. So, depending on the ownership percentage, the market price is given. So, based on this information, we have to figure out the transfer of value. Again, a simple one. We just need to figure out the market values of the shareholding prior to the transfer and after the transfer. So, prior to the transfer, Jamal had owned 20,000 shares. So, as opposed to the 50,000 total shareholding, it's a 40%. So, for 40%, the market value is £6. So, for 20,000 shares into £6 would be 120,000 pounds. So, she is transferring 5,000 shares. So, 15,000 shares would be there. As a percentage of 50%, 50,000 shares, that will be 30%. So, when your percentage ownership comes down to 30, the market price will also come down for 5. So 15,000 shares into £5 would be 75,000 pounds. So the reduction in the estate value would be 45,000. That would be the value of transfer. So I'm taking the third answer as the correct answer. Are we good? Any questions on this one? Rashid, how about Rashid is not there? Okay. Last question on this particular scenario. Select the correct rate and the due date for the payment of the lifetime inheritance tax on Jamal's transfer of 600,000 pounds into the trust by clicking on the relevant boxes. Okay. Transfer to trust. Jamal transferred 600,000 to a trust on 15th January 2024. It has been agreed the trustees will pay the lifetime tax. So trustee is paying means the tax rate would be 20%. Am I correct? Trustee is paying means we assume this 600,000 is the gross amount. So the trustees payment would be at 20%. Right. So the payment date would be it has done on the first half of the year. So 31st July 2024 would be the due date for the payment. Are we good? Yeah, sorry. Second half of the year. Sorry, my bad. It's done on the second half of the year. So it should be go for the uh 31st July 2024. We are good? Right. Then moving on to the second scenario in section B. Again, I'm starting from the requirement because this method will help you to save some time, guys. Even in your exam, usually the information relating to the first requirement will be given first, second one next. Likewise, it will flow. Therefore, you can use the same technique in the exam to save some time uh, by reading the scenario again and again. Let's start from the requirement itself. How much of the pre-registration input VAT can Green Tech Limited reclaim? Okay. Green Tech Limited was registered for VAT on 1st June 2023, pre-registration input VAT. Green Tech Limited incurred input VAT on the following cost prior to the registration. Machinery used in the business. That can be claimed, right? Because the purchase is in April 2021 within the 4-year time band. It hasn't been consumed in the production. It hasn't been sold. It has just used in the business purpose. So that 5,000 we can claim. Consultancy fees £300 paid in 1st October 2022. It is a service. So if it is a service, should have incurred within the last 6 months, which is not the case. It goes beyond the 6-month period. So this 300 we cannot claim. Last one, on 1st February 2023, advertising expenses 400. That is within the 6-month period. So 400 we can claim. 5,000 plus 400, 5,400 would be the input VAT that we can claim, right? Okay. Then I'm moving on to the question number 2. What is the tax point for the supply of energy saving light bulbs by Green Tech Limited? Okay, let's see. Energy saving light bulbs. A customer placed a large order for some energy saving light bulbs on 15th July 2023. Green Tech Limited delivered the light bulbs to the customer on 30th July 2023 and sent an invoice on 31st August 2023. The customer paid on 10th September 2023. Okay. So what would be the tax point? What is your opinion here? Elankesh? Elankesh, are you there? What would be your opinion? Great. So what would be the basic point? 31st July. 30th July, correct. So 30th July would be the tax point. So we just had a question on what is tax point. So when it comes to VAT, we discussed about at which point that we are going to tax it for VAT. So we had actual tax point and the basic tax point, ATP and BTP. So here they are asking for at what point they need to tax. So that's what we were discussing. Ijaz, are we okay? Right. Select whether the following statement regarding the flat rate scheme is true or false. Again, for this one, you don't need to go through the scenario even. Let's see the first comment. To join the scheme, the expected taxable turnover, excluding VAT, for the next 12 months must not exceed £150,000. Yes, it is correct. We do have a limit like that. You cannot go for the flat rate scheme if your expected turnover for the next 12 months is going to exceed 150. So I agree with the first one. It's true. Second one, a business has to leave the scheme if the turnover is exceeding £230,000. That is false. We don't have that kind of a threshold for flat rate scheme. So we can say that is a false statement. Third one, the business must have committed no VAT offenses in the last 12 months. Yes, not just the flat rate scheme. If you are moving to any kind of a, what do you call the special scheme in VAT, you shouldn't have committed any VAT offenses in the last 12 months. It is true. Then VAT invoices will no longer have to be issued. That is false, guys. If you are within the VAT scheme, you have to go with the VAT invoices. Yes, point is taken, Elankesh. So what I'm trying to say is this threshold is wrong. So your point is taken. The why we cannot take this threshold is because they are mentioning it's excluding. Uh, like you said, it should be including, but this threshold is wrong. Are we okay? Elankesh, are we good? It no. When you say excluding, automatically amount will be wrong, isn't it, Elankesh? Because it will be two different amounts, no? I'm not talking about 230. If we say excluding VAT, then it won't be 230, right? Okay. So moving on to the next one. Yes, it would be 230 into 20%, correct. Not 20 actually, 230 into 1.2%. Not, yes, 230 into 1.2 would be the threshold in that case. Yeah, okay? Right. Then the fourth question on this scenario, what amount of VAT will be payable to HMRC by Green Tech Limited for the tax year ended 31st March 2025 if it uses the flat rate scheme? You should assume the flat rate percentage is 12%. Okay, fine. Let's see what are the information that they have given. Green Tech is considering whether to use the flat rate scheme in future. The company's forecast VAT inclusive turnover for the year ended 31st March 2025 is as follows. So zero rated, we have £30,000. Standard rated, we have £60,000. Green Tech Limited standard rated expenses for the same period are 24,000 exclusive of VAT. So in flat rate scheme, the best part is we are not considering this input tax story. Input tax story is out. So we are not considering the input tax. Then what do? We take the turnover figures. Then we go ahead with the flat rate percentage, which is 12% as per the given scenario. We are okay? Right. So, zero rated supply is 30,000. Standard rated supplies is 60,000. Keep in mind, these are all VAT inclusive figures. Huh? Scenario says like that. VAT inclusive turnover. If it was exclusive one, then we have to again go by the inclusive one. We have to multiply by 1.2. But in this case, they have given the inclusive figure itself. So 30,000 plus 60,000, 90,000. The rate is given flat rate 12%. 90,000 into 12% would be 10,800. Then the last question from this scenario. What amount of VAT will be payable by Green Tech Limited if it does not use the flat rate scheme? Okay, if they are not using the flat rate scheme, then we will have to figure out the VAT exclusive amount or the VAT amount and set off the input VAT against that. That would be our mechanism in that case. So zero rated one, no VAT component would be there. Standard rated one, this is VAT inclusive one. So I can simply use the fraction, that is by dividing this 60,000 by 6, which leads to 10,000. Overall output tax is at 10,000. Input is at 24,000, that is exclusive of VAT. So I multiply that by 20%. 4,800 would be the input VAT. So the VAT payable amount would be 5,200. We just need to type that answer in this box. Are we good? Ijaz, Elankesh, are we okay? Right. So usually guys, most of the time, VAT is tested on section B. Rarely only they put it into section C. Even if they put, so far it has been a 10-mark question. So generally that comes under section B. We are okay with that as well. Right. Then let's move on to the third and the last scenario in section B. Again, I'm starting from the requirement itself. What is the chargeable gain on the sale of Kamau's flat before any relief? Okay, so that means there might be some reliefs. We are talking about flat, that means we might be talking about PRR or letting relief. But before those reliefs, what is the chargeable gain? That is what they're asking for. Kamau made the following disposals during the tax year 2023-2024, a flat. Kamau sold a flat that he had purchased on 1st August 2012 for £181,500, including legal fees of 1,500. Okay, that means this 181,500 is with the 1,500 legal fee. So we don't need to reconsider that. During his ownership, Kamau spent £2,000 on roof repair following a storm and 15,000 on a kitchen extension and the flat was sold for £280,000 on 1st August 2023. Kamau lived on the flat. Okay, that means we are going to the other exemptions, which we don't need for the first part. First part is on the pure chargeable gain without considering the gains, exemptions. So cost we can consider. Legal fees already included in the cost. Roof repair. Is it a deductible one? The roof repair £2,000, can we deduct it? Great, we cannot deduct it because it's not an extension or an improvement. It's a repair, so it's a revenue expense. That 2,000 we cannot take. £15,000 on the kitchen extension, how about that? The £15,000 kitchen extension? Yes, that is a capital expense. So we can actually deduct that. So if I put the numbers into an Excel, sales proceeds 280,000, purchase cost 181,500. I took that. Roof repair, I'm not considering, it's a revenue expense. Kitchen extension, it's a capital one. Improvement cost, I deduct that. So the chargeable gain before any relief would be 83,500. So the answer is answer number 3. Are we good? Elankesh, are we okay? If there is a letting relief for the occupied by the owner, does that 9 months we can take, but we'll have to apportion that too. Because part of the house would have been given under rent. No, we are having the letting relief means owner is only occupying one part of the house. No, so 9 months we can claim, but we have to apportion that. In practice, I mean, for questions, yes. In practice, sometimes they don't allow it at all. But for questions, you can apportion and apply. You can apportion only for the proportion that owner has used. 100 days. Yes, we have to apportion based on the owner's occupancy. Let's say owner is occupying 75% of the house, then 9 into 75% would be the apportionment that we can claim. Are we okay, Lankesh? Right. Okay, then I'm moving on to the, okay. Because like I said, not in this one, he is referring to a different scenario, is just in a different scenario where owner has rented out. So letting relief coming into the picture means it's a main residence. Owner is occupying while providing part of the house to rent. So my assumption was 75% of the house is used by the owner. So 25% of the house is rented out. If that is the case, 9 months I can claim only for the proportion that the owner is occupying, isn't it? The rented out part, I cannot give the 9 months relief. Then I have to apportion 9 months into 75%. Are we good? Right. The next one. Select whether each of the following statements regarding reliefs available in respect of the gain on Kamau's flat is true or false. Okay, let's see or let's read on the balance part of this question. Kamau lived in the flat until 1st August 2014, then went traveling until 1st August 2015. He lived in the flat again until 1st August 2017, after which he let it out until the sale on 1st August 2023. Okay, fine. Private residence relief will be available for period from 1st August 2014 to 15th August 2015 as part of the 3 years of for any reason deemed occupation. That can be claimed, right? Because that is for traveling purpose, less than 3 years. And after that, he has occupied the house again once he returned. So yes, 3 years for any reason is applicable. You can claim that. First statement would be true. Private residence relief will be available for part of the period from 1st August 2017 to 1st August 2023 as part of the 3 years for any reason deemed occupation. That is false. Why? Because to claim the 3 years for any reason, you should have occupied the house after that period. In this case, that doesn't happen. After 1st August 2017, Kamau he hasn't resided in the house. He has just rented it out. That means for that period, 3 years for any reason is not applicable. So the second comment is false. Third one, private residence relief will be available for the final 9 months of ownership. Yes, private residence one you can claim the last 9 months because he was not staying at the house. It was fully rented out. So nothing to apportion. You can straight away claim the full proportion in this kind of a situ. Last one, letting relief will be available for any remaining gain relating to the let period, subject to a maximum of 40,000 pounds. Again, we cannot claim this. Why? Because to claim the letting relief, you should have resided while renting. In Kamau's case, that hasn't happened. He has not resided for the rented out period. Therefore, this is also a false comment. So first one is true, second one is false, third one is true, the last one is false. Are we okay with this one? Elankesh, Ijaz? Right. Then I'm moving on to the next one. What sales proceeds figure should be used to calculate the chargeable gain on the gift of 600 shares in TechCo PLC? Okay, let's read about that as well. On 1st December 2023, Kamau gave 600 shares in TechCo PLC to his brother. On that date, the shares was quoted in the stock exchange at 3.54 pounds to 3.6 pounds. Kamau purchased shares in TechCo PLC as follows. On 1st May 2019, 400 shares. 1st June 2020, 400 shares. 15th December 2023, 400 shares. Kamau has been informed that gift of TechCo PLC shares will not qualify for the gift holdover relief. Okay, fine. So in this kind of a calculation, we have been asked to figure out the sales proceeds. Okay. So that is easy, right? We just take the average market price. The highest is 3.6, lowest is 3.54. Add together, divide by 2, multiply by the number of shares sold. So that's what I have done. Average would be 3.57, multiply by 600 shares. The sales proceeds would be 2,142. I hope that is clear for both of you all. It's a very straightforward one. I will not waste a lot of time on that one since it's very, very straightforward. I'm moving on to the next one. What is the total allowable cost that would be deducted in calculating the chargeable gain on Kamau's gift of 600 shares to TechCorp PLC? Okay, allowable cost. Let's see what is the cost. When it comes to individual shares, we had a order, identification order, that we have to match the shares. First, the same day purchases. In this case, the sale is happening on 1st December 2023. Therefore, there is no same day purchases. Next one is next 30-day purchases. We have one on 15th December 2023. There is a 400 shares that has been purchased. So we assume that 400 sold first. So 1200 comes as a part of the cost. He's selling 600 shares. So the balance 200 shares will be coming from the pool. So overall pool has 800 shares. 1000 plus 800, 1800. So I have a portion 1800 divided by 800 into the balance 200 shares, which is giving me a cost of 450 pounds from the pool and 1200 from the next 30-day purchases. So overall cost would be 1650 pounds. I just need to figure it out. That's the first answer. Is that one clear? Yalankesh, Ijaz, are we good? Ijaz, how about you? Right. I'm moving on to the last one. Which of the following would be a valid reason for Kamau's gift of shares in Techco PLC not qualifying for gift holdover relief? What do you guys think? What would be the reason here? Ijaz, Elankesh, according to you guys, what could have been the reason? Why these shares might not have been considered under the gift holdover relief? All right, Ijaz, we have close to 1 week for the exam now, so we'll have to speed up a bit. It seems like yeah, should be quoted and below 5%. Right. So what we can take is the 5% story we can take here, isn't it, Ijaz? So that's the option that they have given here, no? Elankesh, what do you think? So the second one would be the answer according to what you are picking as well, right? The holding percentage is not large enough. Great. So I also feel the same reason because employment doesn't have any impact. Ownership period, not a problem. Connected person, again, not a problem. Then only thing that can be is the holding percentage is less than 5% of the voting ordinary shares. So I'm going for that answer, answer number 2. So section B is done. Are we okay with section A and B? Anything that you guys are finding it difficult? Elankesh, Ijaz, are we okay with section B and A? Right. Let's move on to section C then. Right. Again, I follow the same method. I start from the requirements. So the first requirement, list 4 factors which indicate that Aisha should be considered self-employed rather than an employee in her engagement with Beehive Limited. You should confine your answer to the information given in the question. Okay. So they are trying to tell us to figure out whether this individual is having an employment or not. So first one, you should assume today is 1st March 2023. Aisha, a marketing consultant, has decided to return to work after a period of extended maternity leave. Okay. She has agreed to a 12-month project uh, to rebrand the marketing strategy for Beehive Limited. Okay, so the period itself is a short, right? 12 months. Is that an indication of a self-employment or employment? What do you guys think? It's an indication of a self-employment, right? Because it's a short period of contract. So that could be one of the points that you guys can write. Okay, moving forward. For which she will be paid a yes, employees usually it's a long-term contract for which she will be paid a total of £36,000. Aisha has been informed that Beehive Limited plans to treat this as an employment contract, but Aisha believes that she should be classified as self-employed. Okay, fine. Project will start on 6th April 2023 and end on 5th April 2024. The 36,000 fee will be paid in installments, with each installment paid on successful completion of that part of the project. Aisha has the option to outsource the part of the project to other consultants if necessary. Okay, so we are allowing to outsource to other consultants means we are allowing for subcontract. It's a nature or it's an indication of employment or a self-employment. Again, it's a indication of self-employment. Under employment, generally we do not allow for subcontracting. Okay. Aisha will work from her own office. She will purchase a laptop for £2,500, which she will use exclusively for business purpose. Again, the resources, she has to use her own resources. Her laptop, her office. It's again a indication of what? It's again an indication of a self-employment, right? Because generally in employment, the equipment and the resources will be provided. But here, Aisha have to purchase a laptop and she is using her office as well. So again, a indication of self-employment. Although on the although focused on the project with Beehive Limited, Aisha is free to engage with other clients and projects. Under employment, that is also a bit of a tricky area. You have to get the prior approval, and there are a lot of other stuff that we need to do. I'm not saying it's prohibited with employment, but you have to keep them informed, and certain cases your employer will request to get the approval. But if you are freelancing, no one can stop you. Are we good? Great. So let's read the last point as well. Aisha left her previous employment on 1st June 2020 and has no taxable income since then. Okay, fine. So we already discussed the 4 points that we can write. You just need to put that in this Word document. Are we okay, guys? Elankesh, Ijaz, we are good with the points? Can I move on to the next part? Elankesh, right. Explain how the timing of the payment of the income tax on the fee from Beehive Limited will differ if Aisha is treated as self-employed rather than an employee. So simply, if she is a self-employee, she will have to pay income tax. So for that, she has time till 31st Jan 2025. But if she is treated as an employee, Beehive Limited will deduct the PAYE from the amount that they are paying to her. So upfront, the income tax will be collected. That is the difference. Are we good? Elankesh, Ijaz, what if she earns employment income? That would be her other sources of income, no, then. So that will flow under the normal income tax part. It will be a part of her taxable income. And whatever the PAYE deducted can be given as a tax credit, like the normal one. Yes, if she has any other sources of income, she has to go for self-assessment. But still, for this one, PAYE is already deducted. So upfront already deducted for this one. So even though she has other income, the position for this particular Beehive Limited's income will not have any impact. Are we okay, Lankesh? Right. Then I'm moving on. On the basis that Aisha is treated as self-employed and has no other income apart from the 36,000 fee from Beehive Limited, calculate Aisha's income tax liability and national insurance contribution for the tax year 2023-2024. So I started with the self-employment income. I took that. She purchased a laptop, right? She's self-employed means this is her trading income. Then the capital allowances are available for her. So you can claim AIA for the laptop. Agree? Elankesh, Ijaz, do you agree with that comment? Right. Then the net income would be 33,500 for her. From that, she can deduct the personal allowance as well, 12,570. Her taxable income would be only 20,930, which is below the basic rate band. So I can simply apply the 20% basic rate band. So her income tax would be 4,186. When it comes to NIC, she will have two NICs, class 2 and class 4. In this kind of a question, usually students, there's a tendency that you might forget the class 2 one. But whenever they refer to self-employment, make sure you consider the class 2 NIC as well. So that is a weekly calculation, 3.45 pounds per week. And we assume there are 52 weeks during the year. So 3.45 into 52 would be 179 pounds. Then class 4 NIC up to 12,570, it will be at zero. The balance again, guys, this one is not on the taxable income. This one is on the trading income. Again, a mistake that we usually do. Don't get the gap between 12,570 and the taxable income. Get the gap between 12,570 and the trading income. That would be 20,930 into 9%. So the class 4 NIC would be 1,884. Are we okay? This question, are we good? Great. Ijaz, are we okay? Awesome. Then I'm moving on to the next scenario in section C. Okay, we have another one. Calculate the additional NIC contribution that Aisha would suffer for the tax year if she was treated as an employee. Okay. Employment income £36,000, 12,570 at zero. The gap 23,430 would be at 12%. So the current NIC would be 2,812. Earlier, we had a class 2 of 179, class 4 of 1,884. So previously, she was suffering only 2,063 as NIC, but now she will have to suffer 2,812. So the gap would be 749 pounds. We are good? Ijaz, Elankesh, are we okay? Right. Then let's move on to the second scenario in section C. As usual, I'm starting from the requirement. So the first requirement is about calculate Ellie's income tax liability for the tax year 2023-2024. Okay, fine. That means we'll have to go through the entire scenario anyway. So Ellie was employed by Vector Limited for many years. On 30th June 2023, Ellie resigned from her employment with Vector Limited. And on 1st July 2023, she started a new employment with Metrics Limited. The following information is available in respect of Ellie's employments during the tax year. So now we know what is the requirement. Here itself, we'll start to follow up with what we need to do. We'll start the adjustments while reading. So from Vector Limited, she has an annual salary of 68,000 pounds. So we know employment income will have adjustments. So I'm giving a working number 1 to employment income. So I'm moving to the working number 1. So it will have two parts, income or the employment income from Vector Limited and the employment income from the Metrics Limited. So gross salary is 68,000, but she was not employed for the whole year, right? She was employed only till 30th June. So that means April, May, June, only 3 months. But the salary given is an annual one, so I took only for 3 months. 68,000 total salary divided by 12 into 3. So the gross salary from Vector Limited would be only 17,000 pounds. Ellie used her own car while working for Vector Limited. During the tax year 2023-2024, she traveled 1,200 business miles, for which she received an allowance of 40 pennies per mile from Vector. So it's only 1,200 miles, but we know up to first 10,000 miles, the HMRC limit is 45 pennies. What she has received is less than that. So that means this is going to be a allowable deduction. So we take the gap between 45 pennies and 40 pennies, which is 5 pennies, that into 1,200. So 0.05 into 1,200 would be 60. So that's all about the Vector Limited. So the total employment income accessible from Vector Limited would be 16,940. Are we good with that? Elankesh, Ijaz, are we okay? Great. Then let's move on to the Matrix Limited. Gross salary is 82,000 pounds. So when is she starting the job with them? 1st July itself, she's starting with the Matrix Limited. That means for 9 months, right? So 82,000 pounds divided by 12 into 9, which is 61,500. On 1st October 2023, Ellie was provided with a hybrid electric company car with CO2 emission of 40 grams per kilometer and an electric range of 35 miles. The car had a list price of 37,500. All private fuel was paid by Ellie. So private fuel consumption story doesn't come into the picture. Only the car benefit would be there. So list price, we know they have given straight away 37,500. CO2 emission doesn't have to do anything with us here, right? It's an electric car. So if you are giving a hybrid electric car, we do not decide the rate based on the CO2 emission, but we use the electric range instead. So the range is 35 miles. Let's see how much is the rate. $35 miles means it's coming under here. 30 to 39, which is 12%. So I gave a working for the car benefit. 37,500 is the list price. Rate is 12%. So 4,500 would be the total benefit. But again, car was provided in 1st October. So that means October, November, December, Jan, Feb, March. Only for 6 months the car has been made available for Ellie. So this we need to apportion for 6 months. So 4,500 divided by 12 into 6 would be 2,250, which I mapped here, simply linked. Well, since they are mentioning it separately, I made a line and give a zero value because the full fuel cost is for the private usage is beared by Ellie herself. Matrix Limited provided a flat for Ellie to live from 1st July 2023. The flat was purchased by the company on 1st August 2016 for 250,000 pounds and had a market value of 300,000 pounds on 1st July 2023. The company spent 15,000 on improvements on 1st May 2020. The annual value of the flat is 6,500. Again, the basic charge is straight away, it will be 6,500, the annual value. So Ellie is starting to occupy the house from 2023 July. The house was purchased on August 2016. So is it falling within the 6-year time band or going out of that? Guys, from the date of purchase to date of providing it to Ellie, is it within the 6 years or going out of that? It's going out of the 6 years time band. So that means the market value should come into the picture. Obviously, expensive accommodation is applicable as the cost is above 75,000 pounds. So I gave a working for the living accommodation as well. I'm going by the market value because the 6-year time band is over. So market value is 300,000. 75,000 is the limit. So 225,000 would be the excess. Official rate of interest is 2.25%. This is also given in your tax rate table. So by any chance, if you forget the official rate, just use the tax rate tables that is given. Then the additional charge would be 225,000 into 2.25, which comes to 5,063 pounds. Basic charge is 6,500. The overall assessable value would be 11,563, but this is also given on 1st of July. So only for 9 months. So I need to time apportion this. 11,563 divided by 12 into 9. 8,672, which I mapped here again. Are we good with this one also? Elankesh, Ijaz, are we okay with the living accommodation? Great. Then the next one. Metrics Limited provided Ellie with an interest-free loan of £15,000 on 1st July 2023. No repayments were made during the tax year. No problem. So interest-free means the full amount of interest will be taxable now because she hasn't paid anything. Based on the official rate, we can calculate. So 15,000 into 2.25. So it's given on 1st of July. So you need to time a portion. So I have just included that here. 15,000 into 2.25 divided by 12 into 9. So 253 would be the amount. So from what you called Metrics Limited, she has an income of 72,675. From Vector Limited, she has 16,940, which I took to the face. Overall, total would be 89,615. So that is her employment income. Let's see about the other information. She has received a dividend of 1,500. So I opened another column for dividend income. Took 1,500 there. Okay, pension contribution doesn't have to do anything at this point. So my net income would be around 91,115. So the total personal allowance she can claim, I claim that taxable income would be at 78,545. Now we need to consider about the pension scheme. So 4,000 is the gross amount. So my basic rate band will be extended by 4,000. 37,700 plus 4,000 would be 41,700. That will be at 20%. The gap 77,045 minus 41,700 would be at 40%. For the loan one, you're asking Elankesh, the interest-free loan one. Yes, you can use the average, but in this case, average will not make any difference because no repayments are there. Average method will have a change only if there are repayments. So unless they specifically mention, you can go ahead with the average, no issues. Are we good? Will they penalize for using the average method? No, they will not penalize, but up to now in each exam, if they are testing this loan one with repayments, they have always mentioned what method that they want us to use. So far, they have not kept us in the dark. They have clearly mentioned so far which method that we need to use if there are any repayments. So I don't think there would be an issue, but by any chance, if they do not mention, you can go ahead with the average method. They will not penalize for that. If there is a yeah, you have to use the both and go for the higher. No, that is because what you call the precise method will give you the more accurate answer if there are any repayments, but you will not losing any marks if you use the average. That you don't have to worry. But like I said, I don't think they will change the method that they are testing. Always they will mention which method that you have to use. I don't think there would be a change on the way that they present the question. They will mention which method that you have to use. I'm not expecting them to be silent. Uh, if they are silent for section A, okay. Again, like I said, precise method and average method will not have a big difference in your answer. So you can select the closer one even if you use the average method. But like I said, Lankesh, I'm not expecting them to keep us in the dark. I'm pretty sure if they are checking this, they will mention which method they want us to use. They will say that. So, I mean, up to now, in exam questions, there was no instance where they kept us in the dark. If they want us to use the precise method, they mention that average also the same thing. So I'm not expecting them to change it, but by any chance, if they change, average should be fine. Yes, like I said, even in the class, sometimes we do certain questions for explanation purpose. So that doesn't mean that will be the exam question, right? So for employment income, for an example, the detailed question we did in the class will not be there in the exam. No, the detailed question was for explanatory purpose. Because if you see your exam papers, even if they, okay, for gross donations also they say that, right? If the question doesn't mention whether it is gross or net, go for the gross. But have you seen exam paper, even if it is net, they are not mentioning, no, right? They are in the bracket, they are saying whether it is gross or net. Your examiner is not that rude. He will say what you need to do. So he will definitely mention whether we are looking at the average method or the precise method. We are good? Again, if they are silent, you have to assume it's the net one. But like I said, so far, always in the exam, in the brackets, they mention that. By any chance, if they doesn't mention, you go ahead with the net basis, gross it up and take it. But in the, I'm also against that. I mean, when you say net, the students know what needs to be done. So keeping silent is the best way to test the actual knowledge, but they mention that. Always they mention whether it is net or gross. Are we okay? All right. Then moving on to taxing the dividend income part. Nil rate, we have £1,000. So I took that under zero. Overall dividend income is only 1,500. So the balance 500 I took under the higher rate applicable for dividend income, 33.75. So the overall income tax liability for LE would be 22,647. Are we all good with this one? Ijaz, Elankesh, any questions? Right. Then I'm moving on to the next part. Set out briefly the content and purpose of PAYE Form P45, which Ellie received from Vector Limited when her employment with the company ceased. So I know you guys have done this paper. What is your view about this question? Elankesh? Again, this question was there in the study hub also actually. So what would be your answer? Not a detailed one, just the few points. The question number B. Set out briefly the content and purpose of the PAYE Form 45, which Ellie received from Vector Limited when her employment with the company ceased. Simply, what is meant by Form 45? Yes, correct. So we are talking about the tax codes, total earnings, and the tax deducted at source. That means the PAYE story. Yes, it is issued when resigned. So in this case, she has resigned from Vector Limited. So she will receive this from Vector Limited. The objective is giving the details about the tax codes, earnings, and the PAYE that has been deducted. Moving on to the next one there. State the advantages, state one advantage and one disadvantage for Ellie of Metrics Limited payrolling her benefits. So what could be an advantage? If the company payroll the benefit, what would be an advantage? Okay, no need of P11D, fine. What would be the disadvantage? Exactly. Now, benefits in kind. That means the what you called non-cash benefits will also be taxed at source. It will also come under PAYE now. So that is the disadvantage. So an extra tax will be paid in advance. Right? Let's move on to the last two questions. Okay. Calculate Orion Limited's corporation tax liability for the tax year ended 31st March 2024. Your computation should commence with the operating profit figure 25,900, indicating by use of 0 for items referred to notes 1 to 3, which do not require adjustment. You should show clearly how you estimated the rate for corporation tax to use. Fine. So I'm starting while reading the scenario. They are asking us to start from 25,900. I already jotted that down. Orion Limited has an accounting reference date of 31st March and 190% subsidiary Sirius Limited. Okay, fine. The following information available for the tax year ended 31st March 2024. Operating profit, Orion Limited's operating profit for the tax year is 25,900, which we already took. But this figure is after deducting a depreciation of 17,160. So depreciation we cannot allow to deduct. So I have added it back. The depreciation of 17,160 I have added back to the profit. Then lease cost. The following payments made by Orion Limited during the year ended 31st March 2024 have been deducted in arriving the operating profit above. Lease of a photocopier. Can we allow? Yes, we can. It's relevant for the trade, so we can allow that. It's not a short-term lease. So that is deducted. No need to adjust again. I can have a zero value for that. Lease of car for director, £1,860. CO2 emission, 63 grams per kilometer. Okay, so this director's car, what do we need to do? It's a company, so we don't mind the designation, but it's a high emission car. So only 85% can be claimed. 15% of the lease we need to add back. So 1,860 into 15%, I have added back. Super. 15% will be disallowed also. Then premium paid to acquire a leasehold office. So note, the premium was paid on 1st July 2023 to acquire a leasehold office building on a 5-year lease. It's a short-term lease then. The office has been used in Orion Limited's trading since the acquisition. Okay, fine. But they have acquired on 1st of July. Let's give a working and calculate the lease premium. So I'm going for a working. Premium paid £45,000, then the deduction. Premium into 2% into 10 in years minus 1. So 5 minus 1 is 4. 45,000 into 2% into 4 would be 3,600. I deducted that. So my total one is 41,400. But that is for 5 years. I divided it by 5 to figure out how much is for an year. From that also, we are talking only about 9 months. So I divided by 12 and multiplied by 9. So the amount that we can consider is 6,210, but we have already deducted 45,000. So 38,790 we need to disallow. We need to add it back. Are we good with the lease premium adjustment? Ijaz, are we good? Right. So I'm taking that to the top. Added it here. Then other expenses. The following expenses has been deducted in arriving the operating profit above. Gift of calendars costing £8 each, bearing the company name. So it's a small amount, right? So you can allow that. So no adjustment required for this £800. So I had a line and gave a 0 value. Entertaining overseas suppliers, that we can't allow. So we need to add it back. So I added the 470 back. Donation to a local hospice. So again, donations we cannot allow to deduct it from the trading income. That is a QCD. So I added it back to my trading profit. Later on, as a QCD, we can give the deduction. Are we okay on the, what you called, donations as well? Or the gifts? Elankesh, Ijaz? Right. Then plant and machinery. On 1st April 2023, the tax written down value of the plant and machinery has been given 18,600 and 85,200. So we are talking about capital allowances. So I gave a working for that. We already have the main pool and the special rate pool. So I had 2 lines. Opening balances I took while reading the question itself, 18,600 and 85,200. On 1st December 2023, Orion Limited purchased a car for £33,000. The car has CO2 emission of 55 grams per kilometer and 15% of the mileage will be for personal use by the sales director. Personal use story is not a problem for us because this is a corporation tax related question. But the car is a high emission one. So we have to take it under the special rate pool. We can't consider this in the main pool. So I took the high emission car to the special rate pool column. The company sold machinery on 1st February 2024 for £35,000. The original cost was £50,000, on which 130% super deduction has been claimed. So if 130% super deduction is claimed, is any part of this machine is included in the main pool? So this is not a normal situation. Nah? We are talking about 130% deduction. Any part of the machine can be included? No, right? Then if I deduct the lower of cost or the sales proceeds from the main pool, will it be correct? Can I deduct in that case? If I clearly know I have given the super deduction for this one. Will it be prudent if I deduct from the main pool? It will not be prudent, right? So I'm straight away taking the lower of the cost and the sales proceeds to my capital allowances column. I'm not adjusting my main pool because for a fact I know more than the cost I have already given the deduction from the pool. So 35,000 is the lower one. I'm not adjusting it to my pool. I'm straight away taking that to my capital allowances line. Are we good, guys? Elankesh, Ijaz. Okay. Then I need to balance my pool and grant the capital allowances, I mean WDA. So when I balance the pool in the if it was FIA, then you can do the normal method. Take the cost and the what you call the sales proceeds. Whatever is low, you can deduct from the FIA line from the special rate pool. Because what we have deducted is below the cost, no. We can allow the normal procedure. Part of the cost is within the pool itself, no. Are we okay? If that is the only asset in the pool, yes. If there are other assets in the pool, then it might not result in a balancing charge. We are okay? No, FYA is coming under the special rate pool, no, not under the main pool. Then all the adjustments you have to do on the special rate pool. You are referring to 50% super reduction FIA part, right? Or are you referring to, all right, the normal first year allowance, that means a brand new zero CO2 emission car. Then the same thing, don't adjust it to the pool, straight away deduct from the capital allowances line. Because full amount we have already taken out from the pool, no? No part of the cost is included in the pool. Then do the same adjustment we did now. Oh, yeah, you can call in that way as well. Yep. Have you okay? Right. Then I'm moving on to the next one, new factory. Oh, sorry. We didn't give the WDA. So for main pool, I'm taking at 18%. For the special rate pool, I'm taking at 6%. Then I took the total, which I adjusted here. Like you said, we are ending up with a balancing charge. We are adding back to the pool profit finally. Capital allowances is becoming a balancing charge here, a positive figure. Elankesh, are we okay? Great. Then new factory. Orion Limited purchased a newly constructed factory for 650,000 pounds, including the land of 120,000 on 1st May 2023. The factory was brought into use on 1st August 2023. Fine. First of all, we have to take out the land value. So 650 minus 120, we have to take first. That is point number 1 here. Point number 2, structures and buildings allowance is 3%. So get the gap between 650 and 120, apply 3%. But the catch here is, unlikely the other kinds of capital allowances, structures and buildings allowance is considered from the date of use. So we are using from 1st of August. That means we are only using for 8 months. So 650 minus 120 into 3% divide by 12 into 8 would be our structures and buildings allowance. Are we okay? Elankesh, Ijaz, are we good? All right. Then dividends received. Orion Limited receives the following dividends. Dividend from Sirius, 5,000. We don't need to consider. Other dividends may be required when we are calculating the augmented profit. But for the time being, dividends is not taxable for corporate, so we keep a zero value. So total income would be 96,759. We had a QCD. I'm deducting that from here. My TTP would be 95,559. So I'm anyway above the 50,000 limit. That means I'm going to get exposed to the marginal relief. So I applied the main rate of 25% on top of this 96,559. So my main rate would be 24,160. Marginal relief, I gave a small working here since I have a subsidiary also. So my TTP is 96,559. Non-group dividends is 4,100. Augmented profit is 100,659. So we are talking about a group now. I have a subsidiary which I own 90%. That means my upper limit will be split between the two entities. So 250 upper limit will become 125. Then I just need to apply the marginal relief formula. Upper limit 125 minus taxable profit, TTP, that is in our case 96,559 into the fraction 3 divided by 200 into the proportion between my TTP and the augmented profit, which gives me a marginal relief of 350, which I map here. As a result, my corporation tax would be 23,790. Are we good? Anything that you all are not clear in this question? Right. So with that, guys, we are closing the, what do you call, the pre-mock June 2024. My gut feeling is you can expect a good full 15-mark question from corporation tax, but I can't assure, guys, this is just my gut feeling because of this whole marginal relief story. Something similar to this question can be there in your exam, where you have 1 or 2 subsidiary companies which reduces your upper limit. So this kind of a question might be there in your exam as well. Yes, earlier it was just one rate, 19%. Now this whole upper limit, lower limit, and marginal relief story comes into the picture. And you guys are the first batch who are facing for an exam after they introduce that. So there is a bit of a high possibility that they would test it. So this kind of a question might be tested in your exam as well. Are we good? Elankesh, how about you? Right. Then with that, let's conclude the revision TRG story. So, Elankesh, I think we'll be meeting again on Thursday class. So hopefully we can catch up on Thursday. For Ijaz and everyone else who's watching the recording or in YouTube or whatever, this would be the last class. So wish you all the very best for your exams, guys. Hope you all get through and give me the good news that you got through. Good luck. Just focus on your exam. Don't be panic. Very carefully go through the questions and the scenarios. As you can see in this paper also, certain wordings were tricky, so don't fall into that trap. Very carefully read through the requirements and all. So best wishes, guys. Let me know once your results are out. How did it go? Okay, then let's wind up. Thanks a lot for the participation, guys. So let me know on the results as well. See you guys then. Best wishes again. You're welcome.